please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Greetings on a Wednesday midweek session here on CNBC. You're watching Squawk Box. Bernie Lowe with the team. Headlines. Let's get going. President Trump calls for ISIS to be blocked from the United States and defeated in the Middle East after a pickup truck rammed pedestrians in Lower Manhattan, killing 8 in what authorities are calling an act of terrorism.
Let me be clear that based on the information we have at this moment, this was an act of terror.
The incident coming after them on a high note, fueled by strong earnings from consumer plays like Mondelez and Kellogg, Battle Creek, Michigan. And Apple, a driver for the market, hitting a record high after positive reviews of their new iPhone 10 just in time for the holidays. I want to bring you across to a developing story that we are watching for you. It is a very sad tragedy. 8 people killed, more than a dozen at last count injured, some critically in Lower Manhattan. A pickup truck drove down a bike path at high speed. The truck stopped after crashing into another vehicle, and then the driver got out wielding what police said were imitation guns. Some reports said BB gun or pellet gun. He was shot by police, not killed. He was taken into custody. Authorities are calling it an act of terrorism, but they do believe at this point that he acted alone.
The new terrorist tactic, which they've called for publicly, are these lone wolves who commit an act of terror. This is all very preliminary. It's only been a couple of hours, but at this point there's no evidence to suggest a wider plot or a wider scheme.
President Trump tweeted, "We must not allow ISIS to return or enter our country after defeating them in the Middle East and elsewhere." Although, of course, the investigations are at very early stages and there are no fingers at this point pointing to necessarily ISIS. But U.S. stocks, meantime, extending their strong October gains into the fresh month. I should note that the markets closed before the incident. The 3 indices in their best gains that we've seen since February. Consumer staples, tech leading the way. Apple was way out in front after positive reviews on the iPhone 10. But Qualcomm, QCOM, slumping on reports that Apple was designing iPhones and iPads that would bypass their chips. And on the earnings front, Under Armour under a whole lot of pressure this morning after they slashed their annual outlook. But Mondelez, the food maker, and Kellogg jumping after better than expected results. Let's take a look at shares of Facebook, Twitter, and Google. Lawyers, attorneys from the 3 companies facing lawmakers on Capitol Hill after Russia's alleged meddling in the 2016 elections. Blaine joins us from Washington, D.C. with much more on that. Blaine, it's getting into the nitty-gritty of who done what at what point, why companies like Facebook didn't notice that some advertising was paid for with Russian rubles. Tell us more.
Yeah, Bernie, got certainly kind of contentious at times today on Capitol Hill. Lawmakers really for the first time are kind of getting a look at the full stunning scope of Russian interference in the 2016 election. That's because just earlier this week, Facebook revealed that some 126 million Facebook users were exposed and consumed fake news articles during the 2016 race. To put that number in perspective for you, that's 1/3, nearly 1/3 of all Americans that received fake news stories from Facebook. Shockingly, similarly stunning numbers rather from Twitter. Some 37 million bots, or rather 37,000 Russian bots were kind of putting out these fake news stories over the course of the election season. So as you can imagine, Bernie, yes, this was certainly a lot of grilling that the executives, the reps from Facebook, Twitter, and Google received today on Capitol Hill. Let's play for you what some of those representatives had to say today, and then get from you reaction from lawmakers on the other side.
When it comes to the 2016 election, I want to be clear. We take what happened on Facebook very seriously. The foreign interference we saw is reprehensible. That foreign actors hiding behind fake accounts abused our platform and other internet services to try to sow division and discord and to try to undermine the election is directly contrary to our values and goes against everything Facebook stands for.
At the time of the 2016 election, we observed instances and acted on them of automated and malicious activity. As we learned more about the scope of the broader problem, we resolved to strengthen our systems going forward.
Protecting our platforms from state-sponsored interference is a challenge we began tackling long before the 2016 presidential election.
So, Bernie, of course, lawmakers had been upset that the companies did not seem to be taking this threat seriously, and then had serious questions about how they could be so fully duped in the first place. Now, you would wonder, of course, was this enough to satisfy them today? Were these answers sufficient? You heard passionately from some of the reps from Facebook, Twitter, Google just a few minutes ago. But at one point today, Senator Lindsey Graham asked if they could name what other countries other than Russia were looking to meddle in future U.S. elections, and none of the representatives were able to give any sort of an answer. Bernie.
Okay, this is going to go deep into the veins of these social media companies. Blaine Alexander, our point person there, right outside the White House. It was a decent month in energy oil, but with Brent at 2-year highs. Weekly American Petroleum Institute data showing a fall in crude and gasoline inventories, lending support to oil in the Asian trade for October. North Sea Brent crude up nearly 7%, WTI up over 5%. And as steady as she goes in the Treasury market so far, we're less than 24 hours out from that Fed decision. Janet Yellen overwhelmingly tipped to stand pat with no press conference scheduled after release, despite all the talk of Powell in recent days. Ahead of that, Steve Leisman breaks down the exclusive results of our CNBC Fed survey.
Expecting a statement tomorrow from the Federal Reserve. The CNBC Fed survey shows 98% of our respondents expected to keep rates unchanged. 96% say there'll be a third rate hike coming in December. That's a bit higher than the market prices. And 3 rate hikes are expected in 2018. Let's see what that does to the outlook for rates over the long run. There's the 1 hike for 2017, the 1 additional hike, bringing it to 1.4. There's 3 more hikes there built in for 2018. And then just 2 more for 2019, leading to a very low long-run rate of just 2.9%. That's the bottom of the cycle for many other times we've had the Fed hiking and raising rates. Let's look at the outlook for stocks. Just very much think that the gains for the year already priced in, just 1.7% from here to a S&P level of 2617, going up a little bit more next year, 2700, 2708, for a 3.5% gain from 2017 to 2018. We asked about this corporate tax cut that the president has proposed. Is 20% the right number? Well, 58% of our respondents say yes, it is. 19% say no, it ought to be a little bit higher, and 12% want it lower. But there is one big disagreement they have with how this is being proposed. We asked, should tax cuts or tax reform be deficit neutral? 56% say yes, it ought to be deficit neutral. 44% say no, you can do it while raising the deficit. Steve Leisman, CNBC Business News.
Okay, we're 8 minutes into the hour. Let's see how the markets are getting ready or in the trade already. But Japan is getting ready for Wednesday. And, of course, the new month, the CME Nikkei futures, 22,195, the most appropriate read there. Should take us up about, let's call it 180 points. So we're watching Sony. SNE is the ADR ticker stateside. The company says they're expecting their best ever annual profit figure this year. After years and years of painful restructuring, the focus company on image sensors, which are all the rage, and gaming, of course, which is paying off. New Zealand been open for some time now, and they are currently looking like this with the NZ 50 down 50 points. Australia has just come into play as well. Let's check in with Matt and see what's interesting in the markets today. Morning, Matt.
Morning, Bernie. We've got a gain for the Australian market at the open. 18 points in the money, up by about 1/3 of 1%, which is essentially what futures was indicating. 59.32 on the ASX 200. But have a look at the All Ords back at that 6,000 level, which we've not really seen that much. If we go back to the All Ords, not the Australian dollar, not seen too much since the global financial crisis, because the Australian market traded comfortably above that level, both on the ASX 200 and the All Ords. But then, of course, we saw that significant meltdown in markets almost a decade ago now, and it's been a long run for the Australian market to get back to these levels. Now let's give you a look at the Australian dollar. We are waiting on the monthly China Caixin PMI due for release later on today. Yesterday we had those official numbers, and that did show some weakness in the China official PMI, and we saw some weakness coming through in the currency and also the broader equity market. Take a look at shares of CSR. These ones losing steam at the open, down by more than 4%, despite the company growing its first half profit up by 32% to $136.6 million on a 7% lift in revenue, an interim dividend of 13.5 cents a share. The group says it is on track to meet annual profit hopes in the range of about 187 to 223 million, which is within the range of expectations that analysts have, but the stock sinking today, now off by almost 5%. The Managing Director, Rob Sindel, will be along to chat to us. That's coming up on Street Signs a little bit later on today. We're also watching shares of Myer because we could see some fireworks coming out of that strategy meeting that's going to be taking place in Melbourne today. Significant shareholder Premier Investments and Solomon Lew have said that they will be agitating for change at this meeting and trying to get board positions, which they've so far been denied. It comes as Myer's Q1 total sales fell by 2.8% on year. The company saying sales are held back by intense competition and slack consumer sentiment. So Myer will be one as well, Bernie, that we are watching today. Back to you.
There we go. Just another note here. The presumed or alleged terror attack with the pickup truck hitting pedestrians on a bike path in Lower Manhattan, that happened after the main market closed, which is why it's not reflected in the nominal closes here. But the three indices were up for the month of October. That's what we had. We start a new month, of course, with the Wednesday trading. Jim Awad is Managing Director at Plimsoll Market Capital and joins us from New York. Jim, take stock of October for us and then the rest of the year. I guess it gets interesting from this point on, right, because when we're talking next time, we're going to have a new Fed chief named, and we're going to at least have some idea if tax reform is going to happen this year.
Yeah. Well, what you do know is that the economy is growing. In fact, it's accelerated a bit. Revenues are growing, beating expectations. Earnings are growing, beating expectations. You have low interest rates, a transparent Fed, a pro-business administration, at least getting something done in regulatory fashion, if not in tax reform, which we'll see. So all of that is really very positive. But you also know that the markets are up a lot. They've been up the last 7 months in a row. You're trading at something like 19 times forward four-quarter earnings. The market's up a lot over the last several years. You know that interest rates, although they're low, are going to be going up. You also know that there is a tremendous lack of discipline in the credit markets. The people in the distressed markets tell me it's more sloppy now than it was in 2007 in terms of the credit-like covenants and the lending in the junk bond market. And you know, with rising interest rates, you could get a dislocation from the credit markets. So, and you also have the geopolitical risk and the outside chance, not outside chance, but the chance that the outlook is basically the line of least resistance is up. But from these levels, it pays to exercise discipline in terms of your stock selection and the prices that you pay, because any sort of math you put pencil and paper, you don't get big gains in the stock market from here. You get further gains, but you don't get big gains. So it's a time to increase quality, increase discipline, stick with your stronger horses, and that goes for both the equity and the debt markets. People tend to want to loosen discipline the easier it gets, and really the trick here is to really tighten up the ship a little bit.
Well, anybody who was parked in Mondelez or Kellogg of Battle Creek, Michigan would have had a decent session overnight. But I can't remember the last time anybody said cereal makers and Oreo cookie makers are where you want to park your money, right, because they've got defensive characteristics.
Well, I think in this case it was company specific. They both executed very well. I don't think you're at the point in the market yet where defensive stocks take over from growth companies. I think right now people are paying a premium for growth because you do have a lot of these uncertainties and the market's not that cheap, that people don't want to bet on either an acceleration or a deceleration in the economy, because so far what you see is what you get, an economy that in a bad quarter grows at 2% and in a good quarter grows at 3%. And I don't think that picture is going to change a lot. I don't think the Fed is going to change a lot. I don't think the new head of the Fed is going to change the Fed's trajectory very much. So I think for about another year, you can grind higher in the economy and in the stock market. But understand, because 2017 earnings have been so good, the comparisons get very difficult in 2018, along with rising interest rates. So I think sometime next year, you may make the switch from growth to defensive.
Jim, I'm hearing we're getting more and more guests who are pounding the drumbeat of the dangers of too much money having parked in ETFs and index funds, and heeding Jack Bogle's call and saying that if interest rates do spike up and the 10-year gets anywhere near on the high side of 2.5%, that things could tumble, and that the lack of liquidity on the sell side for ETFs could exacerbate losses. Is that a reasonable worry?
Right. Yes, absolutely it is. The amount of money in both ETFs and in quantitative trading programs that replicate very much what portfolio insurance did in 1987, which is the more the market goes up, they buy, and the more the market goes down, they sell. Something is going to end the bull market. And when it does, I don't know, I don't think it's 2.5% interest rates. I particularly worry about a credit event. But when it does, I think that the action in the markets could be worse than the action in the economy, the underlying negatives in the economy, because so many people are in ETFs. You've never seen an ETF go through periods of massive liquidation, sell orders when they may or may not be related to the underlying stocks, and then the quantitative trading. I'm terrified of when that's going to happen. But my best guess is it's out there a little bit. It's not something that's imminent.